All right, time to look at some numbers. So in our last video, we set the groundwork for this case study, which is a policy on a 49-year-old female where the couple would like to dedicate $1 million. That's a lump sum money they have in cash right now, move it into a high cash value life insurance policy. And in the last video, we discussed that the question that I had asked during our first phone call was, aside from the $1 million, once you get that into a policy, do you want to add more money? And the response was, I don't know. So in that particular case, we want to show a number of options. So what we're going to show is what does it look like if we fund the policy with exactly what you're looking for, the $1 million. And if you're watching this video and thinking, hey, $1 million's too high or not high enough, can add a zero, take a zero off, everything's relative if the policy is set up properly. But what we're going to look at is exactly what they want to see, the $1 million going in, and then a what if scenario. What does it look like if you get the $1 million in and then you continue to fund it beginning the fifth year or from the fifth year onward? So we touched on the different products we had ran for him, which was with Mass Mutual, a 10-pay, a 15-pay, and also a high yearly cash value product. The 10-pay option is great to maximize the internal rate of return. The disadvantage is in a lack of flexibility just with the design limitations that's available with the 10-pay compared to the 15-pay and the high yearly cash value. We provided more detail on that in the last video. The 15-pay product, which has a little bit weaker internal rate of return when compared to the 10-pay, but it does provide more flexibility where you can bounce payments up and down each year. In addition to that, you can fund it for a maximum of 15 years, for the 10-pay, only 10 years. And then the high yearly cash value product, which is great for upfront cash value, especially considering that he is interested in using this for real estate. So it's good to show as an option. Very analytical couple. They want to see everything that's available. And a nice option to this product as well is if they want to continue to pay into the policy without changing that design at all from the get-go, they can do so. So we can fund a policy at $250,000 per year for 4 years, and then keep going for 15 years, and then keep going for 30 years if we wanted to. And we can keep the same design from day one, meaning I can plan to fund it for 4 years. Maybe I plan to fund it for 30 years, and then I can adjust as time passes. So that's a nice option if you're in the boat of saying, hey, I want the ability to go with a 1090 split design, minimum premium, and I want to be able to pay as much money into the policy for as long as possible. You can do it with that product without a mech. Granted, the design is constructed properly. Then also the Guardian product option. And here's what we're going to look at. Option A, $250,000 per year for 4 years. Total of $1 million going into the product. Exactly what he wants to see. Option B, $250,000 for 4 years, the $1 million he wants to get in, followed by $50,000 per year thereafter. And you'll see it for different time periods depending on the product. The 10-pay, for example, we're going to do it through the 10th year. After that, we can't pay anything else in. 15-pay, the 15th year. Then also, what's it look like if you pay in $250K for 4 years and you asked, can I keep paying in $250K per year? The answer is yes, but it will limit your product choices. So let's have some fun. We're going to cover a lot of material here. So beginning with a side-by-side comparison sheet, here's what we started with. And remember, he asked to see a lot of internal rates of return. He wanted to see the annual internal rate of return, average internal rate of return, both on cash value, and then also we ran the average internal rate of return on death benefit. So that's a lot of different IRRs on the general comparison sheet. So as we look at here, when I say him, I've primarily spoken with the husband, and we ran the options on his wife, Mass Mutual, 10-pay, and 15-pay. These two options deliver the strongest internal rates of return when we compare them to the high yearly cash value. That's why I put them on the general comparison sheet. And the first general comparison sheet assumes the $1 million going in, and that's it. What is highlighted in yellow represents his break-even point. So for instance, if we look at the 10-pay policy, what do we notice here? $250,000 goes in. The first year, you've got 222, just about 223. No matter how we spin that, the first year I paid in $250,000. I have a death benefit of $3.25 million, which gives me a $250,000 MEC limit. but I have a negative 10, almost negative 11% internal rate of return. And this is the average internal rate of return we have here. We do not have the annual IRRs on this spreadsheet. Year 2, I pay in $250. How much does it grow by? Do I get that $250 back? No. If I did, it would grow from $222 to $472. I get the full $250 back. But in this case, I see it grow from $222 to $463. So I got less than what I paid back into the policy. This is due to the insurance expenses being heaviest in the first year, and I still am affected by them negatively in year 2. Once I start to hit year 3, what do you notice? You pay in $250, grows from $463 to $723. I get my $250 back and a little bit more on top of it. So the compounding has begun, getting better and better each year. By year 4, you've paid in a total of $1 million. You're just about there. And when looking at the average internal rate of return, that'll be in the red when you have less money in cash value than what you've paid in. You're in the black, in the positive, when you've got more money in cash value than what you've paid in. For example, I paid in $1 million total, paying nothing in beginning year 5. I've got $1,040,000 approximately, so about a 1% average internal rate of return. Then I just let it sit and grow. Gets better and better as the years pass. So the 10-pay product, what was the advantage to this policy? If you saw the last video, strongest internal rate of return. What is the disadvantage to this product? A lack of flexibility. So let's touch on the design here, specifically what I mean when I say a lack of flexibility. Oopsie daisy. So here we go. Here's the 10-pay design, whole life 10-pay policy with MassMutual. Where is the money going? If I'm you, Mr. or Mrs. Client, with the knowledge I have in my head with respect to cash value life insurance, and this was my policy, here's what I would want to know. This is MassMutual. MassMutual as a company, wherever I set that total payment, they will not allow the base premium to be less than 10%. I can run that on an illustration, but when I run the full illustration or submit it to the home office, you'll get a warning in the software and on the illustration that states the total payment exceeds more than 10x the base premium and will not be approved for sale. So with that in mind, what that tells me is that's as low as I can go with the base premium. Here's your base premium, $25,000 with the 10-pay product. The 10-pay product credits about 30%, a little bit more of that premium to cash value in the first year, which is nice. This helps with the upfront equity, lessens the upfront hit, which is the part that no one likes about whole life insurance. We've got this term insurance rider for $2.5 million. It reads renewable term insurance rider. However, with MassMutual, that is a level term rider for the first 10 years, meaning it does not increase. And you can see that here too, where we fund it for 4 years. Then our out-of-pocket is 0 thereafter. Annual surrender, what this represents, this $29,500 is the base premium that's due, but I'm not paying it. And then in addition to that, the $4,500, add those two together, we've got the $29,500. So that's the total, call it insurance expense, that is due, but I'm not paying. Why it reads surrender is the policy is surrendering a percentage of its dividends and guaranteed interest to first pay the premium, and then everything else is kicked back into cash value. So in this example, there's the design of the policy, 10% minimum premium, $250K for 4 years. Annual dividend column. So this is one of his points of, call it frustration, and the frustration was not with anyone or agency in particular, it was more so with the industry. He said, why do insurance companies and the industry market like this? Specifically, if I take this company, MassMutual, I have a dividend interest rate at 6%, okay? Someone who's very analytical is going to say, when I Google search the company's dividend rate, it reads 6%. When I see the dividend column and calculate 6% of my cash value and it doesn't add up, what on earth is going on here? And the answer to that question is 1, the dividend rate is a gross rate that's always credited after the company's insurance expenses. We'll never see a 6% earnings rate. And the other piece is anytime you see a dividend column on a life insurance illustration, the guaranteed portion is not included in that. So for example, this is a 10-pay product, which has a guaranteed rate of 2%, which means we have a surplus of 4%. Those are also both gross rates. The surplus piece is what is reflected in the dividend column. And that'll vary depending on the product. Their 15-pay product is 2.5%. Their high early cash value product, the guaranteed rate is 3%. So it'll vary quite a bit. But we can look at it. We don't have to. The net internal rate of return provides transparency on this, your net cash value, and what is it actually growing by each year. Now, total death benefit, $3.25 million. Where did we come up with that number? Scroll down. Here's your MEC limit, $250,000 because we're funding it less than 7 years. Can easily fund right up to the brim, no problem. So there's our 10-pay product, the detailed illustration. Let's go back to our spreadsheet. Come on, there we go. And let's compare that with the 15-pay product. So the 10-pay product disadvantage was lack of flexibility. I didn't touch on the reason why. We have the renewable term rider attached, not the LISR rider. That's the reason why. You can add LISR to the 10-pay, but then it functions almost like the 15-pay. It's not worth it in my opinion. 15-pay, we attach the LISR rider, and all that means is we build an additional flexibility. With this product, you as the policyholder can adjust your payments one time per year without any underwriting at all. Very, very simple. That's the advantage, flexibility to adjust payments. What's the disadvantage? If this is you and you're trying to assess what product you want, and if you were between these two, what would you look at? Well, with respect to your cash value, there's a difference right off the bat. $223 compared to $213. About a $10,000 difference. If we look at the internal rate of return in the first year, it's about a 4% difference there. That is noticeable. Some people will look at that and say, I don't like that. I'm just uncomfortable with it. Some people say that's not material. All depends on you. Next year, what do we see? I pay in $250. Do I get that $250 back? Almost, but not quite. I get less back than what I've paid in. By year 4, negative 1% IRR. Over here is negative 0.16. By year 5, I'm positive. These two are similar. Let's look at the year 20 mark. $2,067,000, 4% clean. Compared to this, 3.84%. About a 0.15% difference there in internal rate of return. So why would I take this option? Well, it gives me flexibility, specifically to bounce payments up and down one time per year. And then in addition to that, I can continue to pay into it for a maximum of 15 years. So his answer was after the $1 million goes in, do you want to continue to make payments? His answer was, I don't know. So these are all, first, what does it look like if you only pay in the $1 million over 4 years? Looking at Guardian, what do we see? Similar, less upfront. This is a result of them increasing their PUA fees with the new 7702 change, breaking even between years 4 and 5, and then we've got the indexed rider on the far right. So nice comparison here when we look at this. That breaks even, same point in time between years 4 and 5. You've got different death benefits here, which if we would have conducted this study last year, when all things were equal with the guaranteed rates, you'd see even death benefits across the board. We don't see that anymore because if we have a different guaranteed interest rate associated with the life insurance product, the MEC limit will be different on that policy. The lower the guaranteed rate, the higher the MEC limit will be for the same death benefit. What we did in this case was solve for a $250,000 MEC limit. So 2% guarantee, I need 3.25. Death benefit to get the $250K MEC limit. 15 pay, I need just under $4 million. This is a 2.5% guaranteed rate. So I need more death benefit for the same $250,000 MEC limit. This guy, dividend values, Guardian, 3% guaranteed rate. Higher guaranteed rate, I need more death benefit, $4.3 million, to acquire the same $250,000 MEC limit. It can be a little confusing. Higher the guaranteed rate equals higher death benefit for the same MEC limit. Think about it that way. We can always discuss it with you as well if you'd like to connect. But here we've got a side-by-side comparison sheet, which you'll see different assumptions as the years pass. And here's my thing when we're comparing illustrations, is illustrations never come true, or very, very, very rarely come true. At the end of the day, if a policy is designed properly with one of the major mutual carriers, we've seen the proof of performance. They have delivered strong internal rates of return. If we were to get an illustration from Northwestern Mutual and throw it up here, we would see it not look attractive at all from an illustrative standpoint because their dividend interest rate is 5%. Their products have not been illustrating nicely compared to the other major mutuals. With that said, we've seen them deliver just like the other guys. So if one company projects better values than another, does that mean I'm going to recommend them? Not in any way, shape, or form. All depends on the actual data. So here we've got the comparison sheet. One thing I want to touch on actually, which is very important here, is the 15-pay product. The 15-pay product, when we design it with LISR, carries a higher base premium where it is very, very difficult to attain a true 10/90 split. So this is an example where we pay in the $250 per year for 4 years and then keep feeding it at $50,000 per year. Where's the money going? Here's your base premium, $40,000. However, you'll get about 25% of that shows up in cash value right off the bat. That's how this 15-pay policy works. It's right around 25 to 28% of the base shows up in cash value immediately. But as I look at this, so in this example, this was not the Excel sheet we just looked at. By year 5, you would have paid in $1,050,000. There's your crossover point when we've got more money in cash value than what we've paid in. So the main point I wanted to emphasize with the 15-pay product is it does carry a little bit higher base premium as well. When we design it with LISR, we can add RTR instead, like the 10-pay product, and that'll give us a clean 10/90 split, but then we give up flexibility. So that's where it's not always worth it when you look at it just with the different options that are available. Let's continue on here actually. So the next thing I want to touch on here is, or what we showed him, was a MassMutual side-by-side comparison. And sticking with exactly what he wanted to see first, the $1 million lump sum, $250 per year over 4 years, with the 10-pay, 15-pay, which is what we just looked at on the last tab, and then also the higher cash value. You'll see where I'm going with this. So this leads into the additional options. This also shows or displays additional reports. So here's the average internal rate of return. This is what we had on the last tab. But then to the left of it, you see the annual internal rate of return. This isolates what he is earning year over year. The first year, the annual and average will be the same. From that year onward, the annual will be stronger because it's isolating what I'm earning that particular year. The average is going to factor in the first year where I'm negative. So as I look at this, there's my annual internal rate of return, net growth rate, assuming the dividend holds true forever, which won't happen. It's going to fluctuate over time. Same thing with the 15-pay product, and then the high early cash value product. So it's kind of in the product name, high early cash value, means with that product, MassMutual will credit high upfront cash values. Over the long haul, this is one of their weaker performing products. It used to be the weakest, not so much anymore. Their whole life 100, from a cash accumulation standpoint, is not that strong. On a guaranteed basis it is, because it has a higher guaranteed rate, but MassMutual revamped that whole life 100 as of today. When we're shooting this video, March 2022, that product is more designed for a higher initial death benefit, not so much rich cash value when compared to other options. The other thing I want to look at here, average IRR and death benefit. And why is it so high right off the bat? Even with a 10-pay, you're at 1,200%. So what this means is if in the first year you paid in $250,000 and you died, in the first year, that'd be a 1,200% return on that payment. Now, where you can make this look even better is where the whole term life insurance argument comes in. If you spent $2,500 for that same payment to get the same death benefit, what happens? Well, you see a couple of zeros added to that. But that's assuming I die in the first year, and hopefully that does not happen. It rarely happens. But what happens is the internal rate of return on death benefit will come down over time. And the reason why, when you hit age 100, which on the spreadsheet, I don't think that I went to 100, but we can, you'll see where I'm going with this. We get very close to each other. At age 100, the cash value and death benefit become equal with each other. And you'll see these two meet as well. But at age 100 is where a policy endows. That's the terminology that's used. But you'll see that internal rate of return gradually decrease over time on death benefit. So there's the comparison. Now, as we continue to progress through this study, the next part's important and it gets kind of fun too. So looking at the 10-pay, the what if scenario. I want to fund it for, or with $1 million, nothing thereafter. Do you want to fund longer? I don't know. Okay, here's what it looks like if you do. And when we design the what if scenario, if you're an agent, this is so important. Make sure that the original design is identical. So a client does not have to adjust the policy. We're not showing two separate illustrations, one with funding a lump sum and then a different design with funding starting there or funding continuing. These two designs, you'll notice by year 4, are identical. And if he decides to keep on paying into it, he can do so. If not, he does not have to, or maybe he stops after 7 years. We want to design it where it's very flexible. This way you as the policyholder can adjust as time passes as opposed to being told, here's what you got and here's what you have to do. We want to be able to pivot as time passes. But we just see a side-by-side and what it looks like if he decided to continue to pay into it. Did the same thing with the 15-pay product. What you'll notice here, option on the left, you've got the same thing, stopping after 4 years. Option on the right, what it looks like if you go for 4 years. And then scale down to $50K per year through the 15th year, which he could do, just based on his situation right now. But then what's it look like if things go really, really well and he says, you know what? What should it look like, Steve, if I just keep on max funding this thing? $250 per year, funding right up to the MEC limit. How much money would I have? And what do my IRRs look like? Well, you have a lot more money because you've pounded this thing with a ton of cash, which he does plan on potentially accessing over the years. And then the last piece I want to touch on here with MassMutual is their 15-pay product. So with this guy, check this out. 4 years. 15 years. Same product. By year 4, you will notice that everything is identical. The only thing we did here was extend the funding, same riders, same initial design. This way the policyholder can pivot as they go. We don't have to do anything differently when we start the policy. Continue to pay in $250, could be less. And then the exact same thing, but for 30 years. This is where it gets fun. This would be MassMutual's advantage, in my opinion, just when you look at a high cash value policy design. If someone states, I want a minimum premium upfront, maximum PUA allocation so I can experience strong upfront cash values, and I want the option to pay in as much money for as long as possible. MassMutual products, they're higher cash value. Their Whole Life 100 does this. Their Whole Life 65 can do this depending on your age. The 20-pay kind of can. Why I say kind of is it's only 20 years. If someone says as long as possible, they usually want to go longer than that. But can I have high upfront cash values and fund for a long time without forcing a higher base premium like you would have to do with Guardian? Can you do it? And the answer is yes with Mass. And then the drawback would be that I can only make payment adjustments 1 time per year. But if I have the awareness on that, then I can select the option that is truly in my best interest, and I can have a lot of fun with a life insurance policy. But that's what that guy describes there. And then let's look at the Guardian option. So what we ran here is first the $1 million lump sum. The advantage to Guardian is if he wanted flexibility where he doesn't have to pay in $250K per year, he can commit just to the minimum premium. Let's look at the illustration actually. And here we go. So policy for his wife, age 49 female. She would probably get Preferred Plus, but we just ran everything at Preferred, non-tobacco, middle of the road. There's your premium. The premium buys you that whole life death benefit, $916,000. If we stopped there, that would give him a MEC limit of just about $60,000 or so, in ballparking just from experience. So call it $60K in a MEC limit. His MEC limit for this policy is $250,000. That MEC limit is based on what? Total death benefit, $4.3 million. The total amount of life insurance has a direct relationship to the modified endowment contract. So here's what we did. Keep the premium as low as we could, because that does not show up in cash value in the first year. With the L95 product, I don't see any equity buildup in year 1. Beginning year 2, that premium begins to come back to cash value for me. This guy, the term insurance benefit, target additional benefit, this is a term rider, which is a cheap way. If you don't like the word cheap, let's use the word cost-effective way to raise that death benefit, the lowest cost, which raises the MEC limit, allowing me to keep my premium low, keep my expenses low, give me a permission slip to add more money into PUAs. Very fun stuff, isn't it? We've got it scheduled here. What most people do, though, is make this unscheduled. They'll schedule a minimum PUA that typically covers the term insurance cost. So there's our OYT, 1-year term insurance rider, which is a 1-year renewable term. The internal costs increase beginning the 3rd year. However, the net cost, especially with Guardian, tends to decrease if you do everything right. And the reason why is the fun part right here. Term insurance rider. As he pumps money, or if this is you, as you pump money into PUAs, PUA payments show up here. I like to refer to a PUA payment a lot of times as a cash dump-in. And the terminology, just by coincidence, works out nicely here. PUAs, often people think of it as money I'm dumping into cash value. Cash value of ads, money I'm adding toward cash value. This column reflects PUA payments and the interest credited to PUA payments over the life of the policy, any dividends and such. This column does not include any base premium buildup or any cash value that's generated from base premium dollars. So, why I mention that is that the column immediately to the right of it, total face amount of ads, represents how much additional whole life death benefit is purchased from your PUA payments, because PUA payments do buy you paid up additional life insurance, hence the term PUA. So where am I going with this? Well, the term rider cost, where we mentioned that it will increase beginning the 3rd year, the internal expenses. It does. However, the net out of pocket, what we've seen through experience now, is that it decreases over time. And the reason why is as your whole life goes up, the term rider comes down, and then we chopped it off altogether after the 7th year, which is after our initial 7-pay test to prevent the MEC. There's the cash value buildup under net cash value. Let us go back to the Excel spreadsheet, and here we go. What we ran here, all the same product, but guaranteed values, dividend values, indexed rider values, because we can attach that indexed rider, and we can actually switch back and forth between the dividend and index strategy. We can go 50-50. You've got a lot of flexibility there. This is something I like to show everyone, unless you live in one of the 3 states that the rider is not available. One of the states is the state I happen to live in, Pennsylvania. But it is a nice rider to attach. If we attach it and leave it at 0%, it costs us nothing. Some people like to have it in the event there's a correction. They want to flip it on for a little bit, but you can bounce it back and forth over the years. We do have videos that go into full detail because there are charges and things that I do need to be aware of there. But it's a nice rider to be aware of more than anything. But the nice thing about this is this is all the exact same policy, 1 million over 4 years, but different crediting assumptions. Because a question he had was, show me the worst case scenario guarantees, current dividend assumptions. I also wanted to show a best case scenario from an illustrative perspective. It could do better than that if he went all index, but that's up to him, obviously. But we've got the internal rates of return across the board. Last thing we're gonna look at in this video is just what does it look like if he keeps funding it with a guardian option. So here's the guarantees. If he max funds for 4 years and then pays just 50K per year, did the same thing with the dividend and indexed option, and we did it through year 30. With guardian, you cannot 10x the base premium payment all day long. You can do it until that term rider burns out. Here we cut it after year 7. If we kept it on, you'd be able to do this through the 12th year or so. Once that term rider burns out, whatever your base premium is, you can add another 3 times that in PUA payments if it's scheduled. There's a difference between the scheduled and unscheduled terminology when you look at it. And the guardians got a practice where a lot of times they'll accept PUA payments that go beyond what's written in their contract language. They look at the history of a policyholder's PUA payments. They reserve the rights to not accept it, but when you look at how they function and their practice as a company, that's another conversation. I'm starting to ramble. But we've got a nice comparison here as we look at the dividends. So this was a lot of info, but call it just phase 1 as we show different options to him so we can start to narrow down his decision-making process. From here, we start to look into how to use the money. If he wants to use it for real estate, does he borrow directly against the policy? Cash value collateral loan, what is in his best interest? We're going to look at a cash value collateral loan in the next video. Hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.